Thursday, January 31st, 2019, Monaco 64, home of alternative economics and contrarian views. This morning I'm going to talk about how the Fed is going to continue kicking the debt bubble ball down the road and how they've got no plan to stop this bubble of everything, and that one day this bubble will implode and collapse completely. And that's another reason why we need to make sure we learn more about the Fed, make sure we campaign to end the Fed. I'm not in the States, but ending the Fed would be great for the whole world, ending all central banks. And again, I'd like to thank all my viewers for the support, all the donations through PayPal, Patreon, and you can also help support the channel going to the Monaco 64 store to buy End the Fed mugs, Billy mugs. Billy's not here this morning, but he will be back. Billy t-shirts. So this mug says, robbing Americans since 1913, End the Fed, at Monaco 64. And it also says home of alternative economics and contrarian views. So, and I want to today look at a few comments that the Fed Chairman Powell made yesterday at the press conference, and I saved these comments, and I think they're really significant to show people what the Fed is thinking and what they think in general. I thought the questions were actually not bad by the mainstream media reporters. They asked him some tough questions about bubbles, about the Powell put that he's putting onto the market, and he was actually quite well. He circumvented the questions. He answered them, kind of avoided. He was very lawyer-like. He is trained as a lawyer. If you look at his background. Anyway, before that, of course, we'll look at what the markets are doing this morning. It's just before 8 a.m. Yesterday, the markets, Wall Street loved what the Fed did, and what did the Fed do? Well, they said that they're going to be more patient now, and that they might even stop doing the QT. So the market took that as a very, how can I say, accommodative. A few months ago, the Fed was very hawkish, and Powell kept saying yesterday, people brought him up on this. He said, a few weeks ago even, you're really hawkish, and said, well, we're doing the right thing for the situation right now, financial conditions. He used that term a lot. But anyway, the Dow was up 434 points. It was up over 500 during the press conference, and someone even noted that. The S&P was up 41, so up over 1.5%. The Nasdaq was up over 2%. So let's see where we are this morning. Gold, of course, and silver did very well yesterday. Yeah, for traders, short term, it's difficult to say where gold's going to be, in a day or two or in the afternoon. But longer term, listening to the Fed, to Powell yesterday, makes me even more convinced that gold and silver will protect people in the future. Physical, of course. Trading is a different game. But right now, I think gold got up to a high of around 1324 spot gold yesterday. Right now it's at 1320.30, up half a dollar. The range has been 1317 to 1322 overnight. Silver, 1602 right now, down about 4 cents. The high overnight has been 1612. Yesterday, let's have a look here. After the Fed, we got up to a high of 16. Let's have a look. Yeah, 1610. That was the high. I think during the Fed and during the press conference, the aftermath of the Fed decision. So silver's broken through that 16 level, but right now it's kind of testing that. The Dow is basically unchanged right now at 25,012. S&P futures up 6, 2686. The NASDAQ 100 future is up 0.8% or 54 points at 68.60. Yeah, the dollar got hit hard yesterday after the Fed and has continued to drop here this morning, particularly against the yen. Right now, against sterling, we're at 131.37, so the pound's up 0.16%. Euro is just below 115, up 0.16 as well, and the dollar is down 1/3% against the yen at 108.70. And I noticed the dollar is dropping quite a lot against the yuan. We got down to like 670 overnight and yesterday after the Fed. Right now we're at 671.40. Crude oil quite strong as well, almost up to 55 here. We're at 54.56. WTI up 0.4%. The yield curve, yeah, doesn't seem to be too convinced about you know, the Fed picture that everything is great, and it must not be great anymore if the Fed is kind of thinking of stopping, is going to be more patient, is thinking about that they could stop doing QT, or as they use these very esoteric terms just to make sure the public doesn't understand anything. They say, oh, you know, we're gonna normalize the balance sheet, the roll-off. They should explain that in layman's terms, what they should be saying, that we're not going to sell off our balance sheet to destroy money, right? But they don't say that. Yeah, the yield curve doesn't seem to be too convinced, because this morning we're back below 270 in the 10-year yield. We're at 267, down 2.5. And we've seen the curve invert now from 1 to the 7. 1-year T-bill yield to the 7-year T-note yield. Right now, the 1-year T-bill is 258, and the 7 years at 256. So that's inverted. Not a good sign. So a lot of people, I mean, I was listening to the Bloomberg mouthpieces, so to speak, the economists and analysts, before the press conference started. There's a guy there, he's been around for a while, I forgot his name. He said, I just don't get it. If unemployment is at historic lows, if the economy is doing really well, we had jobless claims under 200,000. Why do we need to pause? Why all this dovishness? And they had an economist, ex-Fed person, a woman, I think her name was Ruskin, an economist. She didn't really say the truth, that it's just a Fed put. It came to the rescue of the speculators, the Fed, and that's why they're becoming more dovish. Nothing to do with the economy. So there you go. But as I said earlier, the Fed looks like it's going to keep kicking the ball, you know, debt bubble ball down the road, the everything bubble. And like many people, it's not only me who says this, the next bubble will be existential for the dollar and for the whole monetary system. It's like an evolution. In 2000, it was just a dot-com bubble. 2008 was a housing bubble, and it put the whole banking system under threat. So the next bubble will be triggered by something we don't know yet, but it will put the whole monetary system, the banks included, under threat. And that's why you need to have some insurance outside the banking system. Monetary-wise, that's physical gold and silver, of course. that doesn't mean you can't hold other assets outside the system, like real estate, like land, like fine wine, or whatever whatever you prefer. It's not up to me to decide. Anyway, and why do I say that? Well, why do I say that the Fed is determined to keep the debt bubble going? You just have to listen to Jay Powell. And I will put a link to this press conference below in the description, up in the cards. It's actually the Federal Reserve YouTube channel. And they've got 21,000 subscribers, actually. Less than Monaco 64 at the moment. But yeah, there was a reporter who asked a really interesting question about the national debt. You know, saying that the CBO has come out and said that they're projecting 29 trillion in debt by 2029. And basically, Powell just says, yeah, we all know that the debt is a problem. We've known this for years, but the Fed only cares about the short to medium term. That's not my problem, 2029. Basically, that's what he said. And he said that the reason the debt has grown so much is because of healthcare and entitlements. Says the population is getting too old. Never mentions the fact that the U.S. government is missing 21 trillion, Department of Defense, and House and Urban Development. Never mentions the trillions that have been wasted with these wars in Iraq, Afghanistan, and everywhere else around the world. Doesn't mention the trillions that were used to save Wall Street and his cronies at the Wall Street banks and the London banks and all the major international banks. Never mentions that. So I like to play this clip where this guy asks the question. 35 minutes and 30 seconds. Let's have a look here. Here we go.
Chairman Powell, Mark Hamrick with Bankrate, thank you. As you probably heard, the Congressional Budget Office is projecting that federal debt is expected to surge to about $29 trillion over the next 10 years, reaching the highest share since the end of World War II. First of all, does that sound like it could be a reasonable forecast, with the administration seeming to take plenty of opportunities to question the legitimacy of CBO? And then secondly, what effect does that have on interest rates and the public, if indeed that's even close to being true?
So first, it is important. We don't do fiscal policy. We don't advise the government or Congress on fiscal policy. So I'll limit myself to more high-level comments and say that it is not a secret. It is a long-known fact that the U.S. federal government budget is on an unsustainable path, and that needs to be addressed. And that is driven principally by the combination of healthcare costs, really due to our healthcare delivery system, and the aging of the population. So, and there's no time like now when the economy is healthy, growing, people are working.
Well, the thing is, yeah, the economy has been healthy, but the U.S. is going to be running $1 trillion deficits last year and this year. So he doesn't mention that, by the way.
To go after that problem. Ultimately, we will have to. We don't have a forecast. We don't forecast those things. I have no reason to doubt CBO's numbers on this. I haven't actually looked at that report, but my general experience with them is this: it's a professional outfit.
So what does that look like if that really takes place 10 years down the road?
So, first of all, the work that we do relates more to the medium term rather than the long term. And so I don't see this in particular as a threat to this business cycle or to the...
So you see, he doesn't care about it right now, as long as it's not on his watch. So yeah, he's gonna, his admitted is a problem, but he's gonna keep inflating, keep interest rates low, because that's the only reason why this debt can keep growing, is because interest rates are artificially low. Let me put him back on.
The economy this year. It's more in the longer run, we'll be spending all of our money on paying interest and not on the things that we really need to be doing for future generations and for our own generation. So it's a serious problem, but it's not a problem that is something that either helps or prevents the Fed from doing our job today.
So there you go. He doesn't care about the future. He cares about now, and he even said he doesn't care if people are paying more and more in interest on the debt, and yeah, he'll leave it to. I wonder, if he's going to be around in 2029 as Fed chairman, and I would say the CBO forecast could be even not enough. It could be more like 32 trillion or more. We never know. So I wanted to show you that Powell and the Fed. And he mentioned a lot of times in this press conference that they're doing everything to benefit the American public. Never mentions Wall Street and government and the military-industrial complex. But that's who they're helping. And I know if the stock market collapses and the debt bubble bursts, a lot of people will suffer from this. But the more and more he keeps kicking this ball into the future, the worse, the crisis will be in the future. So it's like it's a sword of Damocles hanging over, the debt is a sword of Damocles hanging over the American public. You're damned if you deal with it, you're damned if you don't. Unfortunately, and that's the message of the Fed. If you enjoyed this video, make sure you hit the like button, subscribe to the channel if you haven't yet, share it far and wide, the video, if you enjoyed it, and you can also follow me on Steemit, DTube, and on Twitter. I wish you all a great day. Take care. Bye.